Okay, now I'm recording. Excuse me. Go back to sharing my screen. All right. Okay. So I was like, change your Zoom name to the name you used to register for class. If you don't know how to do that, you just look at the little box that has whatever your name is in it or your picture. On the upper right-hand side, there are 3 little dots in a little blue box. You just click on that, and an option to rename will come up, and then that way you can put your name in. All right. All right. This is not the next slide. This is the next slide. All right. This is the next slide. All right. So right now we're going to start talking about tax returns, and the general flow of the presentation is how you're going to evaluate your information when you get it in order to start preparing a return. So the stimulus payments, if you'll notice in the upper left-hand side, there's a little green box, and that is going to refer you to the place in the 4012, which is your volunteer handbook. Oops.
Monica, could I interrupt you real quick?
Yes.
It looks like you're in you're not in full presentation mode, you're in presenter mode, showing you the current slide and then the upcoming slide. Is there any way you could I think,
yes,
yeah, you can flip that to either full presentation mode?
yes.
Like
how about which one's this one? Nope.
No, this is, yeah, that worked.
Whatever. Oh, that worked?
Yeah, that was perfect, whatever you just had.
Okay.
All right.
So I've got 2 screens.
Yeah, so this happens to mine too, where presentation will be on one and then presenters on the other.
Okay. Is that it?
That's it.
Okay, perfect. All right, thanks, Matt. Okay, so you'll see in the upper left-hand corner, there's a little green box that has 4012, and then it will refer to a page. And so that is where you can find the information on, in this example, stimulus payments. So all the way through, it'll be there, or in just one case, it'll be on the slide itself, next to the issue itself. So stimulus payments. Stimulus payments are what we call them. The IRS calls them economic impact payments, or EIPs. This is that last payment that was sent out by the government last year, in an effort to stimulate the economy. The last payment was $1,400. That was, it was $1,400 per taxpayer and per dependent. So if the person did not receive this payment, then they can still claim it on the tax return. So, if they got it, the taxpayer needs to report it on the tax return. I got it, and this is how much I got. If they didn't get it, then they can say, I didn't get it, or I didn't get as much as I was supposed to, and then they report that on their return. We have not updated this slide to show that one of the documents that everyone should be bringing in is going to be, what is that? It's a form 6475. There's going to be a ton of forms this year. So it's an income information, and it just talks about the economic impact statement. It will say how much that taxpayer got, and then it's just because at this point, people have forgotten what they got last March. So it's good that the IRS is sending them some information so that they will know what they got. And so when you are claiming that or getting the payment through your tax return, it's called the rebate recovery credit. So this thing has 3 names. It's rebate recovery when you claim it on your tax return. Is it economic impact statement when it came from the government? All right. All right. All right, married filing joint versus married filing separate. Now we're talking about filing status. If you're married, you have the option of filing joint or filing separately. And so I will start by saying that in our software, we do not have a married filing joint, married filing separate comparison tool. It just doesn't exist in the software. So as a policy, our sites do not do comparisons. That would involve preparing like 3 tax returns, 1 for each taxpayer, and then 1 married filing joint. And we just don't have the resources to put into that to do that. So the people pick before they come in, do they want to do married filing separate or do they want to do married filing joint? The reason a lot of times people come in and want to do married filing separate is because one spouse will owe something. For example, one spouse will owe student loans, or one spouse might owe child support, and then the whole refund is taken from both spouses. So the solution to that is to file an injured spouse allocation. And so what that means in general is, if I'm filing with my spouse and I owe child support, then my spouse worked, my spouse had withholding, and so my spouse shouldn't have to pay my debt. So the injured spouse allocation just allocates the income and the credits and the withholding to my spouse so that that part of the refund will be returned. My part will go to pay the debt that I owe, but the other part will go to my spouse. So that is a solution. And the reason that we want to talk to the taxpayers about that is because there are a lot of negatives if you file married filing separate. So for example, there's a general standard deduction, and I cannot remember what it is this year. It's like 24,000 something for married filing joint, or half of that for married filing separate. But if one spouse itemizes, both spouses must itemize. So, you live in a house and, if one spouse is claiming all the mortgage interest and claiming, medical expenses or whatever it is that they're claiming in order to have their, to make whatever their deduction will be, the other spouse is stuck with itemizing, and that could be 0. They could have, very little to reduce their taxable income. So that can be a very huge hit if now you're paying, $12,000 more $12,000 of your income is now taxable, where if you were married filing joint, it wouldn't be. Your tax rate can be higher if you file married filing separate. If you look at the tax tables, you'll start to see that the tax rates for married filing separate were higher. 85% of your Social Security is taxable if you lived with your spouse at any time in 2021. And that's a huge hit. If you have no other income other than Social Security and you file married filing separate, then generally you would think that none of your Social Security would be taxable, but that is not the case in married filing separate. There are also credits that you cannot claim if you're married filing separate. The earned income credit, now this year, and this year only, that's a maybe. There is an exception for if you're married filing separate, if you have dependents, and you live and you didn't support your household. So on the 4012, you look at page I3 for doesn't fit the exception, or I2 footnote 4 for it does fit the exception. You cannot claim the child and dependent care credit. You cannot, there's a reimbursement on refund of adoption expenses that you don't qualify for, student loan interest deduction, and then education credits. None of those can you claim. And some of those are credits that you get money for, education, the American Opportunity, or some of them go to reduce the amount of taxes that you'll have to pay. So they're like really big negatives to married filing separate than married filing joint. You leave a lot of stuff on the table. So generally, if people come in and say they want to file married filing separate, there's some people that come to my site and they say that all the time. I've had to talk with them. They made the decision and it's like, fine, you want to file married filing separate. We've had this talk before, so married filing separate it is. But if I've never seen them before, I give them the information so that they can make the decision. And I give them all this information. You look at the information that they have. Education credit might not be something that even applies to them. Social Security being taxable might not be something that applies to them. But there are a lot of it. There are advantages to married filing joint and disadvantages to married filing separate. Give them the talk one time and then let them make their own decision, because now they have the information to do that. All right, dependents. So we've talked about filing status a little bit. Dependents also goes into filing and into what your filing status could be. And a lot of times what your filing status is going to be dependent on are your dependents. Do you have somebody who is a qualifying child or a qualifying relative? You can have a dependent that is not related to you at all. But that doesn't qualify you for head of household, which is very important to know. But all this information is in your 4012. As you can see here, it's on 4012C1. A qualifying child. So there is a relationship test for qualifying child and qualifying relative. We're talking age dependent for who your qualifying child is versus who your qualifying relative is. The relationship is child or descendant. So if you're looking at a family tree, it's people below you. And then also people out to the side. So a sibling could possibly be a qualifying child for the taxpayer. There's an age under 19 or under 24 and a full-time student, or any age and permanently and totally disabled. There's a residency requirement. They have to have lived with the taxpayer for more than half of the year, and then the income. They must not have provided for more than half of their own support. On their qualifying relative, you'll see right away that the income, there is a limitation as to how much you can make to be a qualifying relative. So the relationship of a qualifying relative is kind of thrown out, but it's not qualifying child. Qualifying child is kind of the preferred, because qualifying children qualify you for more credits than your filing status. There are also credits for having qualifying children for other things. If it's a relative, it depends on who the relative is, but they do not necessarily have to have lived with you. But a non-relative has to have lived with you all year. And this is not a 6-month thing. Did this dude who crashed on your couch, did he live with you for 9 months, more than half the year? No. A non-relative has to have lived with you for more than half, for the whole year, the whole year. All right, so now we're talking about income, and we'll be talking about income and income documents for a little bit. This is a W-2, and what this is going to do, anyone who has worked for an employer as an employee is going to get some variation of this form. It's
Hey,
called a
Monica,
Yes.
sorry, can you go to previous slide? There was a comment saying can't file joint return in the center.
I'm sorry. Can you file a joint return?
No, in the middle, if you see, there is a statement saying can't be filing joint return.
Oh, so if you have a qualifying child, they cannot be filing a joint return with somebody else. So they can't be married and filing a joint return with somebody else. So if you have somebody who's under 19 and married, they cannot be filing a joint return with somebody else. So if you're claiming a child who's under 19 or somebody who's under 24 and a full-time student and they're married, they cannot, in order for them to be a qualifying child for you, they cannot be filing a joint return with their spouse.
It's for them, not for you. Okay.
That's right. Yes, yes, yes. Yeah, that is unclear. Good question.
Thank you.
All right. So the W-2 document, everybody's gonna, if you worked a job, you're going to get one. They're going to look basically like this form. And it's going to have all this information. They're going to look a little bit different, but generally they're all going to look like this. So you'll be able to immediately recognize it. The information, so basically the information is given by the employer to the employee. This information is also sent off to the IRS. So the IRS tries to match this information up. So it's really important that we get all the information in correctly and we get all the boxes filled in. So make sure that starting at the top, that the employee's social security number matches the employee's social security number, their real social security number. Every once in a while, they get that wrong. I mean, I've never caught one, but it has happened. I've seen it when we've come back with a corrected one, or sometimes if it's wrong, we have the right number in, so it might reject at the IRS level. But anyway, the employer identification number is important, and then their address information. That's what you'll have to enter into TaxSlayer. Box 1 is the wages and tips, or any other compensation. That's basically essentially what the person made in income through the year through the employer. And then box 2 is the federal income tax withheld. So that is the amount that the employee paid throughout the year in order to pay what they thought their taxes would be at the end of the year. The Social Security wages is also important. That includes other income that was taken out before taxes, so that it might be higher. So the Social Security and Medicare wages and tips, that is so that that information is put in so that they pay the correct amount of Social Security tax and the Medicare tax, sorry. Box 7, sometimes servers or wait staff or people who work in the service industry might have something in that box. So income that they've received in tips. So we can see here that in box 12, they've made 3 different contributions. On D6, I think on that page, is a description of what the W-12 is, and also a definition for what these codes mean, what D means, what DD means, and what W means. D means retirement contribution. DD is the cost of the health insurance, the employer. And then W, you'll want to remember this for a little bit later on when we talk about the health savings account. W is the health savings contribution, the contribution made to the health savings account, either through the employee, through the employer. So I know these by heart, and I'm sure that Charles, Kathy, and Adrian do too, because you just see them so often. And these are pretty common ones. If they stuck like a Q in there, I'd be confused. But you just see these all the time. So you understand what they are. You just input them with all the rest of the information. And you have up to 4 slots to do that. If you have more than 4, it doesn't even accommodate for that here. But if there's anything weird on there, just talk to your site coordinator if you have any questions. But generally, this is what it looks like, and there's nothing weird on there. All the way down at the bottom, we pay taxes to the federal government. We also pay taxes to our state government. So all the way down at the bottom is where it talks about your state. So in all the problems, you'll see YS, which means your state. Here it would be OH for Ohio, KY for Kentucky, and then your employer's state ID number. That is how the state government, how the employer identifies itself to the state government. So make sure you get the right number in there too. Of course, data entry it's all very super important here. Your state wages, and then the state income tax, how much you pay to your state in order to pay for your taxes that you're going to owe. Of course, just like the federal, any overage will come back as a refund, and then anything that you're still lacking that you have to pay your state. There can also, and almost always is, local wages, local income tax, and locality name. We do not prepare local tax returns. So if somebody comes to you from Forest Park or Cincinnati, or there are a lot of localities, we don't do those returns. Those are responsible. The taxpayer is responsible for doing his or her own local income tax, but that information still gets put in because they will use their their tax return in order to calculate what it is that they owe to their locality. So, but there can be information in those boxes. And usually there will be information in those boxes. Okay. So this is a brokerage statement. And if you are advanced, you can prepare a return with brokerage statement. Do not be thrown off because of the little tiny writing. All you're going to do is you're going to look for the right information to put into your into the tax return, and it is very straightforward. So if you essentially, there are 3 forms of information on this return. If you look all the way on the right-hand side, at the bar that's sort of towards the top of the page, it says Form 1099-INT. That's your 1099, that's your interest income information statement. You can see that box 1, the person was paid $345.60 in interest income and had no tax withheld. That's line 4, and no state income tax withheld either, which is line 17. So you would just put in the amount of interest, and then if it asks for any information identifying the banking institution, which I think TaxSlayer does, then you put that information in. But that's one form, the interest income form. All the way on the left-hand side, you'll see the 1099 dividend form, which is dividends and distributions. The TaxSlayer will walk you through all the information that is on this form. So it will say box 1, put in 1A, ordinary dividends. You would put in the 4560.78 amount. The next line is line 1B, qualified dividends. TaxSlayer will ask you to put in, the form is laid out exactly the way the 1099 DIV is laid out. So it's a very easy form to put in. There is a question on the advanced test that uses almost this exact type of form to put in. So it's the TaxSlayer software will really help you put this information in. Down at the bottom is for capital gains. And then you can see what this doesn't have in it that the test question does have are the acquisition dates. So what date did you acquire the stock? What day did you sell the stock? And it's not here on this page, but this is like a summary page, and there will be pages behind this that has all that information for you. But this is just to show you basically what a 1099 DIV, the dividends and distributions, looks like, the interest income, and then the capital gain sheets. People can and do come in with like a separate interest income statement. I have a Fifth Third bank account, and they paid me $3.25 in interest income for my savings account. They can have that totally separate. And then the same with dividends and distributions. But this one's just one of the accounts one person invested with Alpine Brokerage, and it all comes down on one statement. Any questions on that? All right. The information on that, of course, is on D12 and D24. All right. Another type of income is, now we're starting to talk about retirement income. And this is what your typical Social Security statement looks like. We don't have it in color, but the Social Security statement is white and pink. So usually there's like a little bar, I think, right through here. This bar is pink. It's a pretty distinctive looking statement. It's issued by the government. And everybody's Social Security statement will have the same look to it. It will be that same. And once you see it, you'll know you've seen it. So it's a 1099, I'm sorry, yeah, it's a 1099 SSA. It's going to be the taxpayers. If the taxpayer has a spouse, then of course you'll be entering in the taxpayer's spouse's information as well. TaxSlayer walks you through everything that you need to know, where to put the information in. So basically what you're going to be looking at is box 5, where you see that's the red box where it says net proceeds. And then also it will ask you for the Medicare premiums or any kind of premiums that were paid out of what was paid to the person to pay for health insurance. So that was $17.35.20. And then box 6 is if the person had any withholding from their Social Security. So every place where you have any income, there is a place to show whether or not you paid the IRS anything to pay your taxes. Box 6 is where this is. It is definitely something that people do, but it's not, it's not common for people to have federal income tax withheld, but definitely it's there. So that's something you really you'll always need to look at all the information on these statements, but do not forget to look at box 6 to see if they had any federal income tax withheld. Down at the bottom left, you'll see benefits for previous years, 2019, 2018, and 2017. And if there are any numbers there, oh, okay, sorry, I'm getting ahead of myself. Here we go. This is that exact statement with benefits paid out for previous years. On the previous statement, you see that it's all blank. Generally, there's nothing even down there if there's benefits not paid out for previous years. Usually that's just blank down there. But on this slide, you can see that benefits were paid out for 2020, but benefits were also paid out for previous years, 2019 and 2018. If that happens, then you just call your site coordinator over and have them help you out so that you can fill out the information, because you don't want to attribute all the income to 1 year, to 2020, because that could impact them. That could give them more higher taxable income, and you want to spread it out over previous years so that it's in the appropriate, it's attributed to the correct years so that they don't have a really high tax hit in 2020. All right. Okay, Schedule C. We're still talking about income here. Schedule C is if you are self-employed. So if you are self-employed, then you do not get a W-2 from your employer. You're reporting your own income. Now it's possible because of the people that we serve, the taxpayers that we serve, who are generally low to moderate income. It is possible that somebody does have a job so that they get a W-2 from whoever their employer is. And they are also filing a Schedule C because they're self-employed, meaning we see a lot of people who do driving types of jobs. So Uber, Lyft, DoorDash, Instacart, things like that. People have their own cleaning businesses or janitorial services, or maybe some construction. So that's the kind of Schedule C that we generally see. And this is a sheet that we hand out at my site. We hand this out to the taxpayer, and we ask that person to fill this out to give us an idea of how we can fill out their Schedule C. Schedule C takes into account all the income that you made and then all the expenses that the taxpayer had. And because you only pay income tax on the income that you made. So any kind of expenses that you have go to reduce the amount of income that you have. So that's what all this information is. Because we are VITA sites, in general, we do a very small sector of like the entire world of tax returns. We prepare tax returns for low to moderate income people and within certain limits. And we are trained to do, we're trained to do the things that we do very well, but there are things that are outside of the scope of what we are allowed to do as a VITA site. And all the questions at the top go to what those limitations are. So if your taxpayer paid employees, that is out of scope. If they had more than $35,000 in business expenses, all this is out of scope. An inventory of products for sale. So if your Avon lady comes and wants you to do her taxes, or somebody selling Tupperware or candles or whatever it is, that is out of scope because that requires an inventory. So we don't do that. They have assets to depreciate. That's out of scope. I've been doing this for a really long time. I have no clue what that is. I mean, I understand what depreciation is, but I don't do it. It's out of scope for us. And so we just don't do that. Yeah, and so those are, and it gives a little definition of what items can be depreciated. A home office. We do not do expenses for a home office. A home office is also very strictly defined. So if, for example, if I wanted to use this as my home office, I could not, because this is a room in my house and I use it for things other than, business. A home office has to be used exclusively for business and for nothing else. If you have a business loss, also out of scope. Do not use a cash method accounting, or want to take COVID-19 related credit for sick and family leave. All those things are things that are out of scope for our VITA sites. So what I would recommend that you do, some of these things are, the home office. Does a taxpayer really know what a home office entails? So I gave you the definition of what that was. If they're like, oh, it's really just a part of my house, I do use it for other things. It's like, oh, well, it's not really a home office. You don't qualify for using that as a home office. We can still do your return if you want us to do it. Other things, they have employees or they have inventory. That's definitely something we would not do. But when you turn somebody away because something is out of scope, let them know that, you know, they should seek a tax professional, that it's not that their taxes aren't able to be done, period. Somebody else has to do them. I don't think we do specific referrals, but just let them know that's out of scope. That's not something that we can do. You'll need to take this to a professional to have it done. All right. Okay. So now all this is starting to talk about the things that need to be reported on their taxes. So the very first part on the left-hand side is income. So in order to report income, so for example, I am a drywaller and I worked as a subcontractor, and the subcontractor issues me a 1099 NEC. I worked for her and for her construction business, and you know, I worked for her, you know, several jobs, and at the end of the year, or the big, you know, January, she gives me an NEC, and it's just in one place, all the cash that I was paid by one person who hired me to do work. It's supposed to be a 1099 NEC. It can also be a 1099 miscellaneous if people have not figured out that the NEC is not the correct form anymore, or I guess a K1, 1099K. I've never even seen that. But anyway, those are the forms. And then the amount of cash that the person has received. So that is up to the tax preparer to say, you know, I have these forms that show that I got paid by these various people. Those would be the 1099 NECs, 1099 miscellaneous. And then I made $1,200 in cash, right? So they report that all to you. And then there's a business code that's provided by the IRS. I have a cheat sheet. Let me see if I can share that. Well, I'll go through that in a minute. But they're business codes on the cheat sheet. I have the codes for commonly used businesses that our sites do. You know, the things that I had mentioned before: cleaning, driving, construction, things like that. So all the other things are expenses. One thing that is out of scope for us is actual car expenses. We use mileage. That's what we're allowed to do. And I will have an example of what actual expenses are after I look at this sheet. And then business expenses, advertising, things like, so in one of the problems, somebody has business cards. So that's essentially an advertising expense. You know, the things that you use to run your business, commissions and fees, if you pay your health insurance premiums, all these other things are includable as qualified expenses. One of the things we have on the right-hand column, you can see entertainment, which means meals with customers. So if you are wining and dining a client and you take them out to a restaurant, all these are important details, and it is a marketing expense. You can deduct the meal that you pay for them and for yourself. However, if you are buying your own lunch while you are working, that is not an entertainment meal expense, right? It's just like everybody else who eats lunch at work. All right. So, okay, that's a lot about Schedule C. Let me show you our the other sheet that I have. All right, so this is a sheet that's available to all the sites and is sort of a sheet that helps the tax preparer, you all, to kind of guide your taxpayer through this Schedule C. So we've got the commonly used business codes. These are all the IRS codes, for rideshare, for DoorDash and Instacart, child care, and janitorial services. I didn't put construction on here. I should put that on there. Mileage. Actual expenses are listed so that you know what you cannot include. Gasoline, repairs on your vehicle depreciation, insurance on your car, things like that. Those are all things that cannot be included in expenses because that is included in mileage. It's either actual expenses or mileage, and we are only allowed to do mileage. So it is very important that you understand what is included in mileage. It is different for work from home than rideshare. And by work from home, I'm talking about you have your own business that is located at home. Not you work for somebody else from home. So rideshare, what is excluded is your, you drive from your house to the first pickup. That is considered commuting miles, and that is not included. Your last drop off, you drop somebody off and then you drive home. That is also not included. That is considered commuting miles. And then any personal errands that you run while you're out doing your rideshare are also not included. What is included are anything that you do to drive somebody, of course, but if you are driving for Uber or Lyft and you decide, the rates here where I am right now are not very good, I'm going to go over to another area. So you're over in Anderson, you had to drop somebody else off, and then you're like, it's Friday night, everybody's out and over the Rhine, so I'm going to drive over to the Rhine to be able to pick up people there, and your car is empty, but you're driving, it's related to your rideshare employment, and you're driving to get more customers, or more people to ride in your car. Those are includable. Okay, so basically the miles while you're out driving around, picking up passengers, driving to get more passengers, that's all included. It is different from work from home. So I have a construction business and my office is at home, and I do my work at home, but I travel from home to go to the places where I have to, do my business. I'm driving from here to a house that I'm working on. That is all included. So I drive from here to the house that I'm working on. That's includable mileage. I drive from that house to the hardware store in order to get stuff to work on my job. That is also included. I drive from the hardware store to Kroger to buy stuff for my lunch. That is not included. That's a personal errand. Okay. And then this bottom part is just information to help you get from the taxpayer things that they might not have thought about that are operating expenses. Because just to be straightforward, a lot of times people are very overwhelmed when they are coming to you to have their taxes done. And so you're kind of helping them think through the information that they have, and they might not have thought of this right away. So Uber, Lyft fees and commissions, generally that is something that people think of right away because it's generally on the app that they have or whatever printout that they have. If people buy snacks or refreshments for their passengers, a lot of times people, drivers will have water for you, then that is included as an expense. If you're still making payments on your car, the portion, so the loan interest on your car payments is something that you can deduct. And that is just the percentage that you use for business. So if you use your car 60% of the time for your business, then 60% of that loan interest is what you can deduct. The same with the cost of a phone plan. You cannot be an Uber or Lyft driver without a phone. So that portion of your phone that you use for business is deductible. So again, if you use your phone 60% of the time for to run your your driving business, then you can deduct 60% of your phone plan. If it's 80%, then you can deduct that, just the percentage. Any accessories that you have, chargers, cables, mounts. I was in a car one time that had like just a ton of cables so that you could charge your phone in the car while you were being driven to wherever you were being driven. It was really nice. Mileage tracking software, parking and tolls, anything else that you use for, specifically for your ride sharing business. All right, hopefully that will be helpful. And then these are available. All the site coordinators have access to this. Okay, how are we doing on time? I've been talking for a super long time. Let me see.
5.
Okay. Okay, so is everybody seeing Schedule C now?
Yes.
Yes.
No.
All right. Okay. All right, great.
Yes.
Perfect, thank you. But now I can't see my thing. Okay, I'm back. Do we want to take a break before talking about the marketplace health insurance? No, we're carrying on. All right, good deal. Okay, so this is the marketplace health insurance. We are no longer talking about income. Now we're talking about reconciling other credits that people have gotten. This isn't a credit. This is, it's just a weird thing. But if you're advanced, you get to do this, and it really is very simple. But it does require a little bit of understanding. Marketplace insurance is if you are at 400% of poverty or below, you can qualify for assistance from the government to help you pay for health insurance. It is for this reason that my site, we cut off, our financial cutoff is at 400%, specifically because I think that's maybe a higher limit than some sites, and some sites don't have any limits at all. And some sites have lower cutoffs, but because you qualify, at the end of the year, you've gone out to the marketplace, you've picked your health insurance plan, you have told the healthcare.gov, the government, what your income is for the whole household. And the idea in perfect practice would be that you let the government know all year if there are any kind of changes so that they can adjust the advance payment or the assistance that you're getting to pay for your health insurance. So what this is on your tax return is you are trying to see, did you get enough assistance to pay for your health care? Because if you didn't, then you can recover and get more assistance, and it's just reconciled at the end of the year. Did you get too much assistance? And then you have to pay back the overage that you got. Or was it just right? And everything is pretty much the same. So that's what this sheet is. It looks very intimidating, but really it is not. So first of all, assessing whether or not the taxpayer has marketplace insurance. People are generally confused as to what that is. If you say, people will talk about Obamacare or, so but don't really understand what that means. If you got Medicaid or you have like government assisted health insurance, as in you don't have to pay for it, you're very low income and you get like free coverage from the government, then that is not marketplace insurance. Marketplace insurance is where you've gone to healthcare.gov, you filled out an application, you've determined what your assistance is going to be, and then you've picked out a plan for the year for you and for anybody in your household who qualifies. So marketplace insurance, generally, if you say, did you go to healthcare.gov to get your health insurance? That is enough for people to say, oh no, I didn't do that. Or yes, I did. It is important that people, that you assess whether or not the person got any amount of health and any amount of health marketplace insurance for any part of the year. People forget. The year can be very long. So maybe I've had people who had it for 1 month at the beginning of the last year, and that is now over and they've completely forgotten. And then they come back later because the IRS has said, hey, you had health marketplace insurance and you need to reconcile it on your return. So the example here is of a family that got marketplace insurance for the whole year. So you can see that the taxpayers are both listed, and then the coverage is, so the taxpayers are listed at the top, and in the middle is listed who is covered. So it looks like the parents and a son. And then down at the bottom, the coverage information is a list of how much the coverage costs. And then, so there are 3 columns, and you can see that they're all the same. All the amounts are the same. And the software is going to ask you, are all the amounts the same for every month, or are they different? So in this case, it's the same. So it's really super easy to enter. You enter the first column, column A down at the very bottom, line 33, that 9,000 amount. Then column 2, the 11,000 amount, which is the second lowest cost silver plan premium. And then the last column, which is the advanced payment. So a little bit of explanation as to what column A and column C are. Column A is what the plan costs. So the plan for this family costs $763.61 a month. And then C is the assistance that they got to pay their plan premium. So this family was paying $163.61 a month for their health insurance every month. Okay. So it's pretty easy to read. It's pretty easy to enter. Now this second page is the example of where the information isn't all the same. So sometimes the amounts can change. Sometimes they just aren't any amounts there. So if that is the case, all it is just a little bit more data entry, because the software will come up with you to enter in these amounts for every month. All right, and then at the end, the software will calculate whether the person will owe money because they got too much of a premium assistance, or whether they'll get money because they did not get enough premium assistance. Oh, and we even have slides to show that. We were thinking ahead. All right. So in TaxSlayer, if all the amounts are the same, so that first sheet where you had the $761, you enter the premium amount. So that's the last line. So if we go back here, you'll see down here, line 33, that amount was $9,163. So all the way across, you take the total, and that's what you enter into TaxSlayer. So that's what that looks like. It's just, you have 3 columns and then you enter the totals down there. However, if you had the second example of where the amounts are different, then you have to enter in the amounts in columns A, B, and C for each month. So you'll just be looking at that, and then in tax layer, it'll say what was the amount in January, what was the amount in February. Because in the previous example, if that didn't start until May, I believe, then you just leave January, February, and March blank completely, and then you start filling in all the information for May. Okay. All right, so we're taking a break now before we go to the simplified method. But before we take a break, does anybody have any questions, or is there anything that I need to explain more? Or is there something that you're just dying to ask right now, or that you're confused about? All right, it's all clear. Everybody understands. That's awesome. I'm going to give everybody a 10-minute break. So just come back at 10:15 and, do what you like on your break and come back. And then if you have any questions, we'll start off with some questions and then we'll continue to retirement income. All right. Okay. Thanks. Adrian, thanks so much for answering that. So the second lowest cost silver playing question. All right, I'll be back.
Hi, Mike. It's Amber Twitty.
Okay. It's 10:16, so we're back. Hopefully everybody's back. Before we go on to, we're going to talk about retirement income next. Do we have any questions or anything that was unclear? Anything that anybody has a doubt about? Because if you do, there are probably other people in the same situation who had the same question. So if there are any questions, I'd encourage you to ask them anywhere along the way. The other thing that I want to let you know is, we're going over a lot of information. And while it may seem that, this is a lot of stuff that I just know right off the top of my head, that is not true. This is, I've been a volunteer for a very long time. And plus I had a hand in putting this together. So of course I know all of this, but don't expect to walk into your tax site knowing everything, or that there's an expectation that you'll know everything. You're walking in, especially as a new volunteer, your site coordinator will work with you. If you have any questions, that's the person to ask. Very likely, the site coordinator will point out other experienced volunteers that you can ask any questions of. So just know that you're not expected to walk in as an expert after you pass your test. So the sites we run them with the hopes that both the volunteer and the taxpayer will have a good experience. All right. So let's move on to the simplified method. So here we are. We're back to talking about income. And this is for retirement income. This is a 1099-R. This is the form where retirement income is reported. You can get retirement income if you're retired. You can get retirement income if you're not retired. So for whatever reason, if you had to go in and pull out retirement income and you're not of retirement age, you will still get one of these. So you could be 25 and pulling out your retirement income, and you'll get one of these forms, the 1099-R. However, the simplified method, however, is to calculate for a person who is retired of what of their gross distribution, which is box 1, is taxable. So in this case, you can see that the gross distribution amount is this $19,250, and that the taxable amount has been left blank. I will give you a very important caution about TaxSlayer. TaxSlayer will auto-populate that box 2. And as soon as you hit the enter for box 1, box 2A will fill in with the box 1 amount. In a lot of cases, that is the correct amount. But in this case, it is not the correct amount. So you will want to make sure that you're attentive and that you realize that this is a case that you will have to go in and calculate how much of the distribution amount is taxable. There is a problem in the test that talks about what this is. And so then what you need to do is here. You will, here we go. This is where I say it auto-populates. What you need to ask in order to complete the simplified method is you need to ask what the age of the taxpayer, or if it's a joint account, joint survivor account, what the age of the taxpayers are at the start of the payments. And then how much of the employee contributions have been paid out to date. Sometimes they have that information. Sometimes you might need to look at a prior year return in order to figure out what that is. But let me show you what it's going to look like on TaxSlayer. If you go to the simplified method, is that clear? What it will do is ask you for all that information. Oh, here we go. This is just to show you where it is that you go in order to calculate the amount for the simplified method. And in the middle of the page, you'll see where it warns you the taxable amount is automatically carried and it can be corrected, and that the blue option there is to click there for the options. And then that will give you all the questions that you need to ask in order for to calculate what the taxable amount is. All right. Okay, so there's a simplified method worksheet. This is just taking you through what TaxSlayer is going to show you once you click that, go to the alternate method. and then you pick the, the simplified method worksheet, you'll select that. And then this is what it's going to ask you. The gross distribution amount, and that will pull in automatically. And then the cost of the plan cost at the annuity start date. And then, so you'll see that here, you need to put in the information that they ask for. So if there's a star next to it, that's something that you have to put in for it to calculate. So the starting date of the annuity, the person should be able to tell you when she started getting the first payment. And then you'll see down here, it says, if a joint or survivor annuity, add ages of recipients. That's not an intuitive ask. So it says the age of the recipient at the start date. So if it's a joint or survivor annuity, you need to add the ages of the recipients. So how old were both of the taxpayers at the time when the annuity started? Is that right, Charles?
Correct.
Yeah.
I would just add, first of all, the majority of the 1099-Rs are going to have this taxable amount populated on the 1099-R. Last year I may have had no more than a half a dozen I had to do this. And this is usually for the older tax clients where you have to do the simplified method.
Right.
And a clear indication that you have to do the simplified method is either the taxable amount box is blank or it's populated and the box taxable amount not determined is checked.
Right.
That's a clear indication that the simplified method needs to be computed.
Right.
And most, generally, I would not give this to a brand new volunteer to do. I'd give this to a more experienced volunteer to prepare this return, and to have a new volunteer, to shadow that person just, for the experience of preparing the return. So just to give you a little insight.
Yeah, I think that's very important. Yeah, it's not very common. I will tell you that there is a test question on the advanced, but also they provide you with all the information that you need in order to fill it out. So it is something that you won't see very often though. But this is just kind of to take you through so you will know how to do it if it ever comes up, or at least you can spot it. Some of these things are, I've seen this doesn't look like everything else, and maybe I might need a little bit of help on it or ask the question. So the training's also to help you with that. All right. I'm going to move on. Okay, so now.
Monica?
Yes.
Sorry, I put a question in the chat. When you say age at the time of payment, is it age at the end of that year when the payment started?
It is the age at the time that the person first started taking the distribution. So if they started taking the distribution 3 years ago, what were the ages of the taxpayers when they started taking the distribution 3 years ago? So if the one taxpayer was 65 and the other taxpayer was 59, then those numbers will remain the same every time you prepare the calculation for them. So if it was 113 last year, it will be 113 this year, and it will be 113 every single time you make that calculation.
Yeah, I think my question was more around the birth date. If the payment started in May and my birth date is coming in August, do I take the age as of August or?
So there's some things that will be constant because you're constantly calculating because the amount is changing. The taxable amount can change, but like when they first started getting the distribution, that will always remain the same. how old the taxpayers were at the time when they started getting the distribution, that will always remain the same.
Okay.
So, how much they contributed, that will stay the same. So you're just making a calculation for every year according to their disbursement.
Okay.
Does that answer?
Yeah, I got it. That's fine. There are certain ages, like for children and all, you calculate as of end of the year, right?
I'm sorry, can you ask that again?
I think some places like qualifying child age calculation or something, you do it at the end of the year. Like how old would,
Yeah, how old were they the whole year?
yeah. But in this case, you have to take the age exactly at the time when the payment started.
Yes.
Exactly, yeah, it's as of the annuity starting date, and it's a bit technical, but the annuity starting date is not the same, generally not the same date that your first pension check is cut. Because normally you'll retire at the end of the month or at the end of the month. Well, you'll wait usually a full month before you get your first pension check. Well, the annuity starting date was, let's say, September 30th or October 1, but your first check you didn't get till November 1st.
Okay.
So you go by that annuity starting date. But also in that question is, how many payments did you receive the first year? Well, it would be 2. You got to check November 1st and the 1st of December.
Got it. So Charles, I was asking if the person who is receiving the payment, suppose his birth date is in December, what age do you put it for this simplified method?
It's the age so this is different from a tax age.
Okay.
This is the age that they were when they started receiving the annuity. So I understand what your question, like a child is the child that at the age that they are at the end of the year.
Right.
For the taxable retirement amount, the age is the age that they were at the time that the annuity started.
Got it. Thank you.
Good question. All right. So we're moving on to education credits. So, now we've calculated all the income and we're starting to talk about some credits. And education credit is really pretty common. There are 2 generally, there are more than 2, but these 2 are the ones that we deal with on a very regular basis. The American Opportunity Credit and then the Lifetime Learning Credit. The American Opportunity Credit is partially refundable, meaning that you can get money from the government for using this credit. So up to 40% of it can come to you, and the rest of it does not come to you, but can be used to offset your taxes. So it's only available for the first 4 years of post-secondary education. Yeah, I don't know what I meant by before 2021. Oh, if they haven't completed the first 4 years of post-secondary education before 2021, yeah. You're only eligible for it for 4 years. So you can't, if it took you 5 years to get your bachelor's degree, then you can only use this for 4 years. And it's the first 4 years. You also have to be seeking a degree or some other kind of recognized education credential. So like a bachelor's degree, Or I can't, like if you're going for like an associate's degree or something like that, if there is a list of qualified education places, I think I can't remember, I think it's at irs.gov. You have to be enrolled at least half time. And if you had a felony conviction for possession or distribution of controlled substances, you don't qualify for this credit. It's a pretty specific felony conviction. When you go through TaxSlayer, this is a question that you have to ask. When you ask this question, because it has to be answered, just make sure you let the taxpayer know this is something that everybody is asked. That you can't, in order to get the credit, everybody is asked the question. Everybody has to answer no in order to get it. And you don't have to have income to get this credit. So if you went to school and you had no income, you can file a tax return just to try to get this education credit. Lifetime learning. Lifetime learning is not a refundable credit, which basically means that it can go to lower your taxes, but if there's any excess, you don't get that back as a refund. It's available for an unlimited number of tax years. You don't need to be pursuing a degree, but you do have to be going to acquire or your improved job skills. So, for example, if you have some courses that you need in order to continue to be a nurse, or you're trying to acquire job skills in order to, maybe to progress in your job or to get some kind of certificate, this can qualify for a lifetime learning credit. So this is the form that you'll need from your educational institution in order to claim this credit. It's called a 1098-T. It's really important that you look at your taxpayer and whatever his or her return looks like. Now look for dependents that are maybe 18 or older. If they're, you will ask them if the kids lived with them, if they were students, and that's really helpful for you to determine, hey, were they in college? Do you have this information? Because the taxpayer may not remember or know that they can qualify for this credit. So make sure that you ask them about it. And then if they do, this 1098-T should be pretty readily available to them or to the student, whoever is going to school. So this is issued by the institution. And generally the boxes that are most important to us is box 1, which talks about the payments received by the institution for qualified tuition and related expenses. And then box 5, which is a scholarships or grants. So generally what you will do is take box 1 and subtract box 5, and what is left is what you can include as qualified expenses. If there's anything outside of that, so the person can say, hey, I paid this $12,900 represents tuition only. I also bought books, and I paid for room and board and all that other, they paid for books and I paid for room and board. So you can say, okay, well, if you paid for books outside of this, then that's an additional expense that you can use. If you paid for room and board is not a qualified educational expense. So, you'll want to make sure that or that you can look up what qualified educational expenses are and what are not included. You'll see at the bottom, box 8 is checked for that the person is at least a half-time student. Right? So it's generally box 1 minus box 5. is the amount that you're claiming as expenses. And if there's anything outside of that, so long as it's qualified, you can do that. Okay, and then you'll have to ask the questions to see, is this a lifetime learning or is this an American Opportunity Credit? Okay. So moving on to health savings accounts. Health savings accounts are for if you have a high deductible healthcare plan, you're eligible to put away money that is not yet taxed into this account to pay for qualified medical expenses. This is what qualified medical expenses are. So there are two places where you can find where qualified medical expenses are. It is on page E8, which talks about what qualified medical expenses are for an HSA. And then it also includes what are qualified medical expenses for Schedule A, all right? They are not the same. There are some medical expenses for health savings accounts that are not included in Schedule A, so you'll need to look at both places. So when you're taking your tests and things like that, you'll want to make sure that you look at all the details and read all the footnotes. This is one where a footnote will definitely come in to help you out. Qualified medical expenses include menstrual care products and over-the-counter products and medications. And it has to be paid, they have to be paid via a health savings account. Generally when you have a health savings account, they give you like a credit card or debit card looking thing, and then that's what you use to pay your medical expenses. So you're doing two parts to reconcile the health savings account. It's an advantage because you're using money that has not been taxed in order to pay your, some medical expenses. So you have to reconcile that, and there are limits to the amount that you can contribute, and then you have to verify that the amounts that you used were for proper medical expenses, qualified medical expenses. So this is the document that shows your HSA contribution. And this is from, the bank or the entity that's holding the money for your health savings account. That is generally not your employer. So while it's possible to make contributions through your employer is not generally the one who manages your health savings account. So when you talk to your person, where is this form? Refer them to whoever is managing their health savings account, which is usually a bank. So you'll see that the total contributions made were $5,100. And that's the number that's important to us. We really don't care about whatever the fair market value is. That clearly includes amounts from other years that have been made, that the taxpayer has contributed. A health savings account is unique from a flexible savings account in that you can carry over the funds in health savings account and they just accumulate and they're just always yours. Now, flexible savings accounts, my understanding is you can't carry those over from year to year. So if you will all remember back to the W-2 that I talked about early on, where the taxpayer was making a contribution, and you could see that on the W-2 as a W contribution, this is where it's going to show up. It was made through the employer, and then here it shows up as the amount that is in the account. It's important to know that, there's a limit as to how much you can contribute. You don't want to contribute over that amount because it's just a big pain to try to reconcile that. And then also you make contributions for yourself and other people can make contributions that you can take advantage of as well. So they can, make contributions to your health savings account for you. You just have to reconcile them on your tax return. This is the distribution. So the amounts that you spent from your health savings account during the year. And you can see here in box 1, it's the distribution and the contribution should generally be from the same institution. They're managed, they should be from the same institution. I'm not going to equivocate. It should be from the same institution. So they're managing your contributions. They say how much you contributed, and then this is how much you spent during the year for your qualified medical expenses. So you can see here in box 1 that this person spent $1,850 from the account, and then it's an HSA. It's really important that when you're going through that you ask the person, were they qualified medical expenses? And qualified medical expenses means something to us, and it is likely not going to mean anything to the taxpayer. So you want to say, did you spend it on over-the-counter medication? Did you spend it for doctor's visits? What did you, were these for, basically, what did you spend this income on? And if they say things like, hey, I bought a health club membership with this, then you'll want to make sure that you say that's not a qualified medical expense, and that will need to be excluded. And so for anything that's not a qualified medical expense, you'll have to back that out. So let's say that the person paid $500 for a yearly expense to their, for the health club membership. So $1,350 was correct, and that was a qualified medical expense, but $500 is not. And so there will be, that amount will be taxable. And I think there's a penalty. There's a calculation on how much tax you have to pay on that when you don't use you don't use it for a qualified medical expense. So just make sure you're very clear with your taxpayer, so that they understand the question that you're asking. All right. Any questions on HSA distributions? All right. The earned income taxpayer credit look back. What this is, of course, everybody knows we've been going through this pandemic, and it has impacted us in a lot of financial ways. People who have it's just affected us in ways that you can work and what work is available and your ability to earn. And the government has taken that into account by saying that if your income this year in 2021 is less than what your income was in 2019, that we can make a calculation and you can claim your earned income taxpayer credit based on the one that is most favorable. This is in scope, and but it is relatively easy to do. So it's really important that in order to be able to do this, what you're going to do is you're going to prepare the return as usual. And then you're going to note what the balance or the refund amount is due. And if you have done any amount of the practice lab, or when you do go into practice lab, you'll see that the software keeps a running total on the right-hand side as to what your adjusted gross income is and what your refund or balance due is going to be. So that's where you're going to look. It's the right-hand side in TaxSlayer. And once you've finished the return, you've finished everything, then you go back and say, well, I want to, this person's income seems really low, like really, really low. And maybe their 2019 income, if it's a little bit higher, would mean that they might qualify for more earned income taxpayer credit. because the earned income taxpayer credit is kind of a bell curve. You know, it starts down at the bottom if you have very little income, and then the more you earn, the more earned income taxpayer credit you get, and then it starts falling off if you earn a lot more until it phases out. So depending on where you were in 2019, you might have qualified for more earned income taxpayer credit than you might qualify for now. You're doing that comparison. So you finish the return, and then you go back to the personal information, the basic information. And that is where you can find where you put in the 2019 income. And then you just make the comparison. Did the comparison help? You know, yes, they're getting more earned income taxpayer credit, or did it not help? You know, the outcome, I'm looking at the refund or amount due box, and it's not changing. So if that's not the case, then you just remove it. Okay. So it's really important. The information that you will need for this is not only this year's information, but you also need to know what the 2019 income was for the taxpayer. And the taxpayer is not going to know that right off the top of his head. So having the 2019 tax return is very important, and figuring what the earned income is from that return is also very important. Because that's what it's based on, is the earned income. Right, so this is where the look back is. You'll see on the left-hand side, we're in the basic information tab. And you just scroll down, and there are a whole bunch of check boxes that you will see. And you just find the one that says that the taxpayer wishes to elect their 2019 earned income to figure their 2021 earned income credit, or the child tax credit. The reason is for COVID-19, that is automatically filled in. And then you just want to put in the first box, the amount of earned income that they had for 2019. You go all the way down to the bottom and hit complete, as you do for any information that you put into the tax layer program, and then it should come up and it will show you on the right hand side whether that refund or amount due amount is higher or lower. And then you just go with the one that is higher, you go with the one that's higher. If it doesn't make a difference, you just go back and take this information out. It's just a calculation that tax layer does for you, so there's nothing else that you need to do except for figure out what the earned income is and put it in that box. Okay.
That again.
Sorry?
Oh, can you hear me?
Yes.
Oh, okay. I didn't know you could hear me. I've been having trouble with this machine. So you put in the you still put in the regular income. You put this in a separate place. You don't put this in for their actual earned income.
No. So this is a separate step. You prepare the return as usual, just like you would prepare, you just go ahead and you prepare the regular 2021 return. And then at the end of that, now all the sites somebody has gone through at our site, somebody really, really smart and super dedicated and really loves taxes, went through and constructed a model as to when these amounts kind of break for the amount earned and the dependents that you have to figure out where this really is valuable. But if you don't have that, it doesn't matter. You just go through, you see that the amount earned in 2021 was less than the amount earned in 2019. You do the regular return. Once you're finished with that and you have the 2019 earned income amount, you go back to the basic information, put in the earned income amount, and that's where you can make the comparison.
But generally, you're going to want it if they made more in 2019.
Yes. The basic facts have to be you made less in 2021 than you made in 2019.
Okay. And while I have you, because I'm having trouble with my computer, on the simplified calculation back on the pension, the first entry you put in on that form, I wasn't exactly sure what it is that you put in there. And you can wait till you're done and maybe I can ask you after you're done with your presentation. But,
Okay, yeah, because I'm not
Yeah.
exactly sure what you're talking about. So yeah, we'll wait to the end.
Okay,
Okay, thanks.
thank you.
You're welcome. Okay, any other questions on the EITC look back? So generally prepare the 2021 return. The 2019 earned income is, and remember, this is not adjusted gross income. This is earned income, specifically earned income, not adjusted gross, is less than the 2021 earned income. Then you come back and then you take this extra little step to see whether or not it makes a difference. So it's really easy to do. And if you're not sure for sure it's worth it, it's, you know, it could be worth a lot to the taxpayer. All right. Okay, so this is I think this is the end of our presentation. All we have next is some examples. So we can go back now to the simplified method and answer that question.
Okay.
Okay, so
Okay, go ahead.
are you talking about in TaxSlayer, what you do?
With that first form you had in the, I guess it was in TaxSlayer. Yeah, TaxSlayer. Oh,
So this is where you put the information in for the 1099-R, the tax,
Okay.
you know, the form where you get,
Okay.
you're just putting in the information as to what the income was and who paid it and everything else, just like a W-2. But you notice that the taxable amount is not calculated. So here, right in the middle of the page, it says, do you need to calculate the taxable amount?
Okay.
So generally what this is going to look like is, you know, 2A, right? 2A is already there. Do you need to calculate the taxable amount? Yes. And then it says click here for options. So you click on that box and it will take you to here.
Okay.
And so you pick the simplified method worksheet.
Okay. Okay.
And then from there, that's where
What
it
is
has.
it that you put in that first box there?
You might not have that information. And then you can just put in the start of the annuity.
Okay. All right. And then getting down here, I can't see this real well, but you put the start in, and then what do you put down below? When it says the number of periods, is that the one?
So the start,
Maybe just, if you can go over it again.
Sure.
Maybe.
So you put in the information that you absolutely must have. So the starting date of the annuity. And then down below that is the age of the recipient at the start date. And if it's a joint, so if it's just a single person and it's not a joint and survivor annuity, then you just put in the name of the age of the individual at the time the annuity started. So this age is always going to be the same every year. If it's a joint and survivor annuity, then you add the ages of the recipients combined. And that is also the same. And it's also at the age that they were at the start of the annuity.
Okay.
Okay. I don't have the whole form here, but it will walk you through the information that you need.
I think what I remember when I was working on it, it said number of periods, I think. And that confused me, like it was a one-time payment. So that confused me.
So if I remember correctly, the person, you know, so answer, you put in the information that they supply you with. So if they're asking you for information that you don't have, then especially for test purposes, you don't need it. So don't try to make anything up if
I
you
don't
don't
think it
have the
allowed me to
information.
do that, but maybe it did.
But also, you know, if the person had started receiving the annuity in April,
Okay,
then it's the amount of payments that that person received in the year, right? If this person has been receiving payments for 3 years, then the amount of payments that they received in 2021 would be for the whole year. So that would be 12.
you lost. So you're acting as though it's a monthly payment. But wasn't it a one-time payment or something?
This is a monthly payment.
It was a monthly, okay. Or maybe I misunderstood. I know in the example in the test, I didn't get I got the idea it was a one-time payment. It was a monthly payment.
So the simplified method worksheet is to calculate, so you start, this is an annuity. I'm trying to back up far enough.
That was.
This is an annuity, so the person is getting monthly payments, right?
Okay, you just assume that, okay.
Yes.
All right, so the example in the book, was that a one-time check then, a monthly payment? Like they had
If you're doing the simplified method
form?
worksheet, the
Yeah.
person is getting monthly payments.
but the amount that we saw was for the year, right? The gross distribution. Or am I misunderstanding something? There was an example, there was a gross distribution from the,
So on a 1099-R,
right,
box 1
right,
is what the person got the whole year.
okay. But you assume that they're getting monthly payments. Okay, thank you very much. Now I
Yeah, sure.
understand.
Sure.
Okay.
Good questions. Anybody else have any other questions or anything that you want to go over?
Monica?
Anything is unclear?
Monica, this simplified method and all is only for the annuity. Because sometimes you get 1099-R, like if you're doing any kind of rollover, things like that.
I'm having a hard time hearing you. Is this Sanjay? Maybe if you could speak more directly into your mic.
Can you hear me? Okay.
Go ahead, go ahead. So you're talking about retirement income?
Right. So if you do a rollover, like something like rollover, you also get 1099-R.
Yes.
That doesn't come into all this simplified method, right?
No, because a rollover is different from a payout. And that is I think it's in box 7 on your 1099-R. Will show you the type of distribution that it is. Do we have a box 7 on here? Yes, we do. Okay, yay. They all do. I just couldn't find it. Okay, so in this example, you will see that in box 7, the distribution code is 4. And they conveniently wrote in there that 4 means death benefit. If you have a rollover, I cannot remember what the rollover code is, but the code, it's like a 2 or I can't remember what the rollover code is, but in any case.
I believe
sorry.
I believe it's G for
G.
rollover, if I'm not mistaken.
No, I think you're right. So the code, right. So the code in box 7 will be G or whatever the code is for a rollover. It will also, there will be no taxable amount. And then it will not be included as your income because there was not a distribution. So you would definitely have to input the 1099-R with all that information because there was, there was a change in the 1099, in your retirement, but it's not a taxable event. And that's shown because of the code in box 7.
Okay, thank you.
You're welcome.
Hey, Monica.
Yeah.
I just wanted to go back to the previous question about that first box in tax layer. you will need the total pension costs to make that calculation. So that's either going to be provided on the 1099-R in box 9B, or they're going to have to provide like the retirement paper that they got when they first retired, and usually it'll include what their total pension costs, after-tax pension costs are, what their total pension cost is in the plan. They're either going to have to retrieve that if it's not on the 1099-R in order to compute that, to do the simplified method. So,
Okay, thanks. Clearly, I am not the simplified method expert at my site, but you can see on the on the 1099-R, all the way on the bottom left, right? And 9B is the box that shows your total employee contributions, and that was the, and that's the number that you would put in there.
I'm trying to look back at the test booklet just to give you enough information for you to pass the test. The one example I see, I think it's the Kenneth and Martha Kemper example. It's a
It was the
joint-
first one.
excuse me.
Was it scenario 6?
Let's see, page 130. Oh, no, I'm on the wrong, I'm in the wrong section. That's qualified experienced volunteer. I don't need that.
I think it's. Yeah, it's on page,
81.
yeah, 80, yeah. The one with the Gilbert Washington and Tara Washington.
Yep.
Yeah, and they have all the information that you need on the 1099-R. Okay. Any other questions about this, or if anybody has any questions about anything else, any questions about volunteering or, you know,
I have a question about, I guess they've been talking about, some people have been get stimulus checks, they've gotten some money already for I guess for the returns that they're going to be filling out. So they're not going to get as much on their return because they've already received, or is that EIC? So they will not be receiving as much because they've already received some.
I think what you're right. I think what you're talking about is the child tax credit.
Correct.
Right. So the
Right.
child tax credit was paid out in up to 6 payments last year. So if you have qualifying children, there are 2 categories of credit that you can get up. So it's if your child is between the age of 6 and 17, that amount was $3,000 per child. If your child is under 6, then that's $3,600. And taxpayers were eligible to sign up last year to get paid up to half of that over 6 payments starting in July of last year. All of those people who receive those payments will get a form 6419 that will tell them how much money that they got last year. Sometimes people weren't able to sign up right away and they didn't get all the money that they could have gotten. And so what you'll be doing, or what we'll all be doing, is reconciling what they got last year and what they still qualify for, what they still qualified to get but did not get. So that
Right.
could be half, or it could be more than half if they didn't get anything.
For the 2021 taxes, that's for,
2021, right.
okay,
So they will either be filing for whatever is missing, or maybe they didn't get any. People also can get this if they had no income at all, which is different. So you might
Okay.
have people who come to have their taxes filed and they have no income, but they're coming to, to reconcile the child tax credit and to get the rest of
Okay.
that. Just like people who qualified for the stimulus and don't generally have to file taxes, and maybe they didn't get the third stimulus. I don't expect so much of that last year because hopefully they got the first two and then they would have gotten
Okay.
the third one.
Okay. Thank you.
You're welcome.
And I think you said like locations. I think that you emailed that already. I think then you were just, when you're ready to sign up. I was waiting till I took the test before I tried to sign up.
Yeah, sure. Yeah, I think that Matt sent out letters to everybody with a
Mhm.
link to all the sites
Okay,
and where you can volunteer and the site hours and locations.
okay,
So, yeah.
Yeah,
all right.
Monica, I'll jump in real quick on that one. That was sent through a United Way email. And if you just need any clarification on anything about the sites, contacting the site coordinator, anything of that nature, you can either email freetax@uwgc.org, and that will ultimately land with me, and I will make sure to help facilitate a connection if you need me to help with that. But that site list does direct you to the primary contact. In some instances, some sites have a volunteer coordinator that you first reach out to if you're new. Other sites like Charles, Monica, Kathy, Adrian, they're all still the primary contacts for volunteers. So in many cases, the site coordinator is the primary contact, but occasionally we do have some other intermediaries we start with. But feel free to email me if you have questions.
Okay, thank you.
If you do not have, I'm going through some scenarios right now. We can go through these if anybody wants to. But what I'll say is, if you need to pick up books, hard copies of books, they're all available online. So the 4012 is available. The 6744 is available. These are all available at irs.gov, the IRS website. You just put the number of the publication that you want in the search box and it will come up in its entirety. The really nice thing about that is they're searchable. So you can put in, child tax credit and it will tell you all the places in the 4012 where that comes up. But the 4012 resource guide, the volunteer standards of conduct, if you need any help on that, the intake and interview and quality review, and then just the training guide. So those are all your resources for taking the test. The 4012 has all the information that you need. If you wanted extra, if you really were unsure or you wanted more in depth, then you can go to any of these other things to give you more information. And then if you wanted a hard copy of the 4012 and the test booklet, the 6744, then you can come to any of these locations at the times listed and just walk in and pick them up. I know that we have a lot at the Center for Great Neighborhoods, and so they're all available to you. The other thing, because we have a little bit of time, I'm just going to put up, if you're really stuck, if you need some help, you can email me. And and include your contact information so I can get back to you. And either I or somebody else will get back to you. It's probably me. If you have any questions. I can't give you the answers to the tests, but if you get stuck or if you have a particular question or there's something you don't understand, send me what your specific question is and I'd be happy to answer you. So does anybody else have any other questions or since we have some time, we could go through some of the scenarios and talk about those.
Are many sites still staying open as a walk-in, or are they, because of COVID, they're changing their operations?
Matt, did you want to talk about that?
Absolutely. So if you're seeking a site from which to volunteer, using the email link that we have, using the link within the email that was sent, there are descriptions of how each site is operating. I would say that the vast majority of sites are using a drop-off model. This model has different iterations within it of how it actually functions, but largely the notion is that a taxpayer will come in and meet with a greeter and or screener for a brief period of time to either pick up an intake form, and in some instances, that form and other things will be completed in a separate space away from other filers or preparers. As the case in one of our sites, they may be asked to go out and wait in their cars. At our high school, actually, we have runners that run out to cars, drop things off, run back in, and kind of facilitate things that way. So many sites operate in that sort of model where then all of the preparation occurs at a distance remote from a filer, either sometimes through the course of a week, and then the filer returns a week later for a follow-up appointment. Or we wouldn't really call this a drop-off model, though, I think we're a little bit with semantics here. But many sites will also do something similar where, again, a filer will come in, they'll initially do their intake, they may wait in a separate space or in a car, and then after that intake is done, it will be reviewed and tax documents will be dropped, and then the person will be asked to remain either in a car or in the facility, socially distanced, away from the preparers, and the preparers would be in a different space doing the work, and then it would be on-site, same-day service. We've traditionally referred to a lot of our service models historically as face-to-face. There is very little face-to-face, if any, occurring. There may only be one site that will do face-to-face this year. There will be some degree of separation depending on each model. And if I know that I've given a long explanation, but that's because there are many different iterations of how this all works ever since the outbreak of COVID-19 and the pandemic. Really, there's just so many different models, just each with their own little nuance and idiosyncrasies. But feel free to shoot me an email, and I'll be happy to go really more into depth about each one if you care to hear all that. Did I answer your question?
Yes.
Okay, good.
Any other questions about, we can talk about this, how sites work, or any specific tax questions. This is your chance.
Monica, you want to take a look at the chat? I
Yeah.
think there was a question about qualifying child.
Sure. Qualifying child. Qualifying child.
Well, that's a
All
good
right.
one.
Well,
Do you have an example in an upcoming slide?
Yeah, let me see if I have
I think you do.
I do.
That like with the grandparent, the child, the grandchild, Barbara, I think. No.
Okay, so,
Eh, not really.
so we could, Barbara's not so. Okay, let's just talk about Barbara and then we can sort of riff off of Barbara. So Barbara's 35. She's been divorced since 2017. She has twins, Charles and Charlotte, who lived with her all year, and she provides all their support. So first of all, all right, so what we don't know about here is all we know is Barbara and that the kids live with her and she provides all of her support. So let me, I'm gonna do something else. Okay, so you can all see that I am on a web browser. I've come to irs.gov, and in the search box up here on the upper right hand side, I put 4012, which is the resource guide, and then here it is. Now, and for those of you who don't know, if you Control F, it'll bring up a search box, and I'm just going to put independent. So this doesn't. Who has to file? That's not what I'm looking for. Oh my gosh, there are 332 references. Well, because dependent is super common. Dependents, here we go. That's the tab I want. So you can click over here on the right-hand side. Oh, don't make a liar out of me. Okay, well, you used to be able to click on the right-hand side and it will take you right
You
there.
got it.
Yeah, no, it's not going.
Not
It's not
all of
going
them
to
are
do that.
linked.
But that's
Sometimes it
okay.
doesn't work.
So we're just going to go to C1. Oh, what page is that? Oh, C1 is, it's individually numbered. Not helpful. This is way easier in your book. I wish Mary was here to hear me say that because she loves print. Okay, here we go. No, no, no. No.
Monica, you could do a find on C-1 and that'll, if that's what you wanted to do.
Thank you so much for that. This is torturous. Okay, C1.
Just hit enter a couple of times or that down arrow, yeah. And I think, there you
I think I
go.
passed it.
Yeah, up one. There you go.
Yay. Okay, thanks. All right. So, overview for claiming dependents. All right. So this is the rule. Does it have a decision tree? I think this is the decision tree is for, so qualifying children have a lot of implications. It will determine your filing status. It will also determine what kind of credits that you can get. But so this is a sheet on C1 that talks about what a qualifying child is versus qualifying relative. And qualifying child is important for the child tax credit, it's important for the earned income taxpayer credit, and it's important for your filing status. So, so the tests to be a qualifying child are laid out here on the left-hand side. You have a relationship requirement, you have an age requirement, and then you have a residency requirement. So on the right-hand side, you see qualifying relative. And the qualifying child, you know, just kind of tries to kick you out of qualifying relative, back into qualifying child. There is a relationship test here, or there's like an exception. Yeah, because a person can be a qualifying relative who really isn't related to you. And that's B. 2B is a person who lived with you all year as a member of your household. So your friend who lived on your couch the whole year, who didn't make more than $4,300, you provided more than half of the support for, you provided the cost of the household, and you provided for more than half of the person's total support for the year, then that person could be a qualifying relative. It's a technical term. So the person does not necessarily have to have been related to you in that case. All right. So let's talk about qualifying child of more than one person. You will look at these, there are tiebreaker rules in the case that a person, a child can be the qualifying child of more than one person. There are tiebreaker rules, and then there are also special rules for children of divorced or separated parents. There are times when one person, the parents have decided outside of the tax arena, inside a civil court, that one parent is going to claim the child in even years and the other person is going to claim, the child in odd years, or if they have more than one child. So our job is not to look at these agreements and evaluate them and to see whether or not they're valid or not. The taxpayer will provide you with the information as to whether or not they can, they are the ones who are entitled to claim the child. And then we just ask the questions to make sure that they are eligible to claim the child. And then there are times when a person will come and two people have claimed the child, mom filed first and she claimed the child, and dad filed second. And because mom filed first and he filed first, dad's return is rejected. So that doesn't mean that if dad is the person who should claim the child and is entitled to claim the child, that he is still able to claim the child. It's just the return needs to be mailed because it can't be e-filed. Somebody's already used that child as a dependent for e-filing purposes. My recommendation to everybody who is having a taxpayer mail a return is to send it some trackable way. You can send things first class mail. And the cost is it's like under $5 the last time I did it. It is really important, especially now when the IRS is very behind in processing some returns still, to make sure that they have proof that they filed their return on time, and that at least they can say, the IRS, they don't have to sign for it. the way that you send it is just confirmation that it was delivered, and that's it. There's nobody needs to sign for it. But these are kind of crazy times for the IRS. They're very understaffed. So if you're going to mail something, I would always recommend that you let the person know, hey, when you send this in, just send it in first class, but trackable. Are there any specific questions as to like who can claim a child, or the 4012 gives you the information as to who can claim a child, who can't claim a child, and tiebreaker rules. We do have somebody who comes in every year. She has an agreement with her ex-spouse, and they share. One person claims the earned income credit, and I mean they split things up. And I give that to an experienced volunteer who can do that. So I think that one of the good things about the 4012 is that it has a lot of information. It has a lot of specific information. But as you can see here, you have this information, but you also have the footnotes. And the footnotes are just as important to read as all the information that's in the bigger writing. There are rules as to whether or not the person has to live with you if they are a qualifying relative. And I can't always remember it because it's really pretty deep in the weeds, but I believe that if you have, let me see, the qualifying relative who doesn't have to live with you as a member of your household. So that's footnote 2. And footnote 2 says, there are exceptions for temporary absences, children who were born or died during the year, children of divorced or separated parents, or parents who lived apart, things like that. You want to make sure that you read those because a lot of times they can be very inclusive. So somebody who you thought might not have qualified to have somebody as a dependent because I had a taxpayer who supported her father all year in his household, but he never lived with her. The rules were that she could claim him as a dependent. And that really made a difference for her, with this, being able to claim that person as a dependent. A qualifying relative is generally worth $500 off of your tax debt, right? So you don't get any, with the exception of the EIP payment last year, which was $1,400 for any dependent. And I believe that included your any other dependent. The other dependent, qualifying relative, that person, the maximum credit that you can get for that person is a credit of $500, which is not refundable. It just goes to pay your tax. All right. Okay, so can anybody think of a complicated qualifying child? Yeah. So
What's
I
it-
guess.
What's the question, Monica?
So a complicated scenario with a qualifying child of 2 not together parents. So first of all, a qualifying child is important if you are separated from your spouse. So, you know, I was married at the beginning of the year. I'm still married now. I separated from my spouse in April, and I have care of my child who I've had living with me since that time, full time. In that scenario, instead of having, and I maintain the cost of a household. In that scenario, I have a qualifying child. Let's say the kid, the child was my 10-year-old daughter. So, my child, under 19, lived with me for more than half a year. She does not have any income herself. And so I provided all the support for her. She's also not married, so she's not filing a joint return. And so she does not meet the rules for the qualifying child of more than one person because she's lived with me the whole entire time. So that not only entitles me to claim my child as a qualifying child, but because of the specific situation where I have lived apart from my spouse and have a qualifying child, that entitles me to file head of household instead of married filing separate, which is really an advantageous filing status, and for possible earned income credit, and then the child tax credit. There are times when if you have the qualifying child of more than one child, it talks here about the relationship, and if you file jointly, that's easy. But if you are, I just can't on the fly come up with a complicated scenario where the person qualifies for both. But these are the tiebreaker rules that are really important to look at closely if you have that situation. But I will go back and say that if there is a fight over who claims that child, that is not our fight. We do the tax preparation to the best of our ability. We do it, correctly with the information we have. We advise the taxpayer of the way that they can file if they, meet the tests and they can qualify to claim the child and mail in their return. But if there's anything else, then generally, that's something that they have to prove with the IRS, and then they are on their own for that. If the IRS says, hey, prove that the child lived with you, come up with all the proof, that is on the taxpayer. And then if there's a fight as to who actually can claim the child, if the taxpayer says, hey, that person is not entitled to claim, that's not on us. We do what we can. And then the fight is a civil court fight between, the people who can claim the child, if it comes down to that. All right. What else have we got? I guess if you've all looked at your 4012, you know that they have very helpful like diagrams that show you how, for example, filing status is one that's really helpful. They kind of walk you through what you need, what you need to determine. Let's go back. We can run through some of the scenarios if we want to do that. Okay, are we on Barbara Bullock? I'm going to assume everybody can see Barbara Bullock, unless I hear
Yes.
otherwise. Okay, all right.
We can see
thanks. Okay, awesome. All right, so Barbara, she's been divorced since 2017. She's got twins. Charles and Charlotte lived with her all year. She provides all of their support. You know, and then she withdrew $5,000 from her IRA. The money was used to pay for summer camp and new school uniforms for both of her children. She has a sister, 38, and her sister's boyfriend, who were evicted, and they live with Barbara now. Each had less than $4,000 for income, and Barbara provided more than half the support. And then Barbara would like to claim Clara and Daryl as dependents. So who can Barbara claim as dependents? Just like a straight out, who can be a dependent on her return?
Say both of them. But
But
Daryl would have to be not a, what do you call it? A relative, not a relative, but the Daryl would be something else. He would be the
no, you're on it. You're on it. The
Yeah.
qualifying relative,
yeah.
right?
And Barbara's actually a, I don't know if Barbara, I guess both of them are qualifying relatives.
Is it this like there is a child too, right? There would be 3 dependents. If the 2 other adults are not filing married jointly, then they can be as a dependent, right?
That's right. So Clara and Daryl, they can be qualifying relatives. Oh, wait. No.
No,
I forgot. So, look, you have to look carefully. So look at Daryl first. Because I think Daryl is kind of the easiest one to look at. So let's start first of all with the kids. Are the kids eligible? Is she eligible to claim the kids as a dependent?
yes,
Okay. And
Yes.
why is that?
her children.
Well, but it's more than that, right?
And they have been living with her for like a whole year, so she supports them.
Right. So
Who's
so you
supporting
just
them?
run down that test, right? So the first one is the relationship test. They are her, they're her grandchildren. No, they're her children. Sorry, in this one, they're her children. They're the right age, right? They're under 19. And if you look at number 3 on page C1, they lived with her for more than half the year. We're going to assume they had no income. Oh, they did not provide for more than half of their support because Barbara provided all of their support. We're going to assume that they are not married and are not filing a joint return, although we would never assume, we would always ask. And they do not meet the rules for being the child of more than one person, the qualifying child of more than one person, because they lived with her all year. There's nobody else that they lived with who might contest Barbara for the dependency, and then she provides all their support. So the kids, you go through all that, they are her qualifying children. So for the qualifying relative, so they're not a qualifying child, right? So we're looking at Daryl now. Well, we can look at Daryl and Claire. So they're not the qualifying child of you or anybody else. And they are not required to file an income tax return. Or if they are filing an income tax return, it's only to get a refund of the income tax withheld. So if you have income that is less than $4,300, you can file a tax return, but you're not filing it because you have to. You're filing it to get back anything that you might have paid in order to pay your taxes, right? But you don't have a filing requirement. And so that's the case here. They have to either be related to you, or they have to live with you all year as a member of your household. All right. So we would have to look closer at that test for Clara to see if she meets that relationship test. If she meets the test of a person, it's table 2, step 2. So turning the page, the table 2, step 2. Which is on page C4. Was the person your son, daughter, stepchild, or brother, sister? So she's sister. And then did the other person live with you all year as a member of your household?
Yeah.
Right. So for both Clara and Daryl, the answer is no. They cannot be claimed as dependents. Because while they might have,
not a whole year.
right, they did not live there the whole, the income is fine, and the relationship for the sister is fine, but it is the living with all year as a member of your household that they fail. So she can claim her children, the twins, but she cannot claim her sister or her boyfriend. So,
one quick question.
yeah.
If Carla was living there for a whole year, would that Barbara can claim her?
Yes.
And also the boyfriend, since he's a boyfriend, or is the boyfriend not allowed to claim because he had no relationship with Barbara?
So so on C1, the qualifying relative, they either have to have, you are like related to, if you have the relationship, or if you lived with that person, the taxpayer, the entire year. So next year, let's say that they crash on her couch, or crash with her next year for the whole year from January through December, then that would be enough if all the other conditions are satisfied, the no income or the less than $4,300 worth of income, and Barbara provided more than half of their support, then that would be enough for Clara and Daryl to be dependents.
Question again. If they started living in with her from March of 2020 to March of 2021, is there, they live for one whole year, but can they be claimed in any tax file?
Nope.
Okay.
No,
Thank you.
because what we're talking about is the calendar year. So, your taxes are prepared based on what happened in 2021 for us. So we don't care about what happens in 2020 or 2022. It's just, did they live with her all year in 2021? And if the answer is yes, then yes. And if the answer is they lived with her only 9 months or 10 months in 2021, then they cannot be claimed as a dependent.
But Monica, if they lived with them, with her for entire year, even in that case, Daryl cannot be claimed as dependent, right? Because he is not related to her.
The question is not, did they live with her for a year? the question is, did they live with her the entire tax year? And they say, yeah, it's the tax year. We're not looking outside of the tax year. So
I
it-
understood, but if in this example, if they lived with her for the entire year, entire tax year, even then she cannot claim Daryl as a dependent, right?
she can claim as Daryl as a dependent, because if you look on page C1, on the right-hand column, test to be a qualifying relative, in box 2, it says the person either A, and then it talks about what it is, or B, must have lived with you all year as a member of your household, and your relationship must not violate local law. I don't even know what that means, but him living, her sister's boyfriend living with her all year does not violate the law. So there doesn't need to be a relationship there. The fact that he lived there all year and that she provided more than half of his total support, and that his gross income was less than $4,300, and that he is not her qualifying child, all those go into making him a qualifying relative for tax purposes. And the thing that, I think that we're hung up on, he's not related, but he did live with her all year. And she provided more than half of his support, and he made less than $4,300.
Okay.
I have a
One quick
question.
question here.
Okay,
Do Carla and Daryl, they can do any tax file, or they cannot do, since they are claimed by the Barbara, right?
so there is the filing requirement, and can they file? So the filing requirement is the test as to whether or not they can be claimed as dependents by Barbara. And they don't have a filing requirement because they have less than $4,000 in income. I can't remember what the filing requirement is over the standard deduction, right? Unless I think there's some other things, but they do not have a filing requirement. Okay, so because they don't have a filing requirement, they can be claimed as a dependent. Can they file a tax return is the second question, and the answer is yes. They can file a tax return because they've earned less than $4,000 in income, but if they had any withholding, they'll want to get that back. So they can file to get their withholding back. They don't have to, but they can. And if they do, that does not take them out of being a qualifying relative, because the basic rule is that they do not have a filing requirement. Okay, that's just like a child who is a dependent of her parents, who has like a little job, and she can still be claimed as a dependent by her parents because she didn't earn enough to take her out of, well, there's no, as far as we're concerned, we don't have an earning cap for kids who are under 19, but still they can file their own return to get back whatever taxes they paid in, if that's what they're trying to do. And they get their refund back, but that does not take them out of being a dependent for their parents. So some of these, I think one of the things is that some of these things are independent. So can you file a tax return? Yes. Must you file a tax return? No. Is that helpful information? Does that help?
Yes, yes.
Okay. All right, there's another question.
Yes.
Monica, oh, go
I
ahead.
have a question. On the
page C4 decision tree, when I'm following it for Barbara's sister Clara, I don't see how the person has to have lived with her the whole year.
Let me see. Yep, I think you're right. So was the person your son, daughter, brother, sister? Yeah, so if the person is one of those people related to you, then you skip where was it that I saw that you have to do that they have to live with you? But you're right. If the person
wasn't-
is related to you, brother, sister, then that person is related, you get a step 4, and it's just an income question. It is not a residency question. The residency
So
question
potentially,
is,
if we follow this through, Clara might count as a dependent. We're not at the bottom yet, so
Right.
I don't know.
Yes.
Sure.
Yeah. Yeah, because it looks like there is, some other questions if she lived with her sister for more than 6 months. And it looks like there might be exceptions for if she did not live with her for more than 6 months. So yeah, that's right. Charles, you were going to say something?
That's exactly what I was going to address. I wanted to go back to Clara. This is a complicated, scenario, and it's a good example because you would think determining filing status is easy, but there are certain situations, filing status and dependencies are easy to determine, but a lot of times there's cases where it's not hard or easy to determine, and you're just going to have to go back to the 4012 and go step by step. And I'm in agreement that Clara is a qualifying relative in this case.
Right. Yeah, you are both right.
I apologize. I had to rush to the bathroom and I had the speaker up so I could hear you, but I couldn't speak at the moment.
Right. See, that's what quality reviewers are for. All right. So, yeah, if you look on B8, and that's, the decision tree for filing status. So that's something that will be really helpful for you if you are unclear. All right. We're getting close to the end. Anybody else have any other questions? I'm hoping that the interaction, what we've done in these last 20 minutes or so will kind of give you an idea of how to look up this information on your own. Make sure that you look at it very closely and do not just gloss over it as I did. That way, you need to look at all the print and all the fine print and all the footnotes. But that way you will come up with the right answer.
I do have one comment to add back to this Clara Cooper.
Uh-huh.
Okay. She does not actually have to have any residency requirement because she is a sibling.
Uh-huh.
So it doesn't matter that she was only there 9 months or 3 months. I mean, I actually have had the same situation with my sibling. He never lived with me, but I supported him, and his income was less than the standard deduction or whatever it is, the filing requirement.
Right.
I could actually claim him as, at that time they called it an other dependent, which only gave me like the $500 or whatever it did for it.
Right.
But because the sister is being supported by her other
More
sister,
than half.
that familial relationship is enough to not make the residency requirement a requirement of her, obviously for the boyfriend who is not related.
Right,
He has to be there for the year.
right, right. What does it say specifically?
On this intake interview and quality review test questions, do we have to do it on ourselves, or are we doing like what we did it last time?
Do you have to take the test?
The second one, part B, I have not taken the test, so I have to take it on my own, or like how does that work?
Yes, you take that on your own. So every year you take the test, and it's yes, you have to take it. And yeah, you'll take it on your own. I think the questions in that test are pretty straightforward and pretty intuitive, I think. Just remember that there's no such thing as a self-review. All returns need to be reviewed. They need to be reviewed with the taxpayer. And you can't have the taxpayer sign off on a return before it's been quality reviewed.
I have it down here. It's almost over. It's still going.
All right, so those are all good questions. I'm going to put up the last slide again so that you can, if you have a question, you can email me and either I'll answer you or somebody else will answer. And then if you need to pick up, wait, that's not the one. This is the one. And then if you have to pick up your materials, this is the information for that.
Will you be emailing us this PowerPoint? I found that useful that we got a copy of last week.
Matt, do you post it or do you email it?
So great question. Yes, I dropped this in the chat. Probably on Tuesdays when the slide deck will go out to all participants of this session. So we'll have your email and it will be sent out that way. It will also be posted on the website along with this recording by most likely the end of the week. Just depends on how busy my marketing team is to get that post up. Hopefully it could be up by Thursday, but I don't want to promise the recording and the slides on the website any earlier than end of the week next week, but you will get an email with these slides included if you've registered.
Thank you.
All right. If there's nothing else, I'm just gonna thank you all for coming. I hope that you all have a fantastic volunteer experience. This is going to be, the sites, we offer very good service, and they do their best to make sure that volunteers have a good experience and that taxpayers have a good experience. It's an awesome opportunity to really help people. So thank you all for being interested in this, and I hope you find you have a great experience at your site. Thank you very much.
Thank you.
Thank you.
Okay, thank you.
Take care, Anthony.
Anthony's in for the long goodbye.
Monica, you can go ahead and stop the recording.
Okay.
Be a little bit, I'm going to try and trim this one down this week. We couldn't trim the first one down, so I'm going to have to do it myself.